Here we go. So let me run through it. It's going to take probably the best of half an hour to run through everything. So obviously you all know the subject, what we're talking about. It is of great interest to many people. So the agenda for today, I'll just run through an introduction. Then I'll do a comparison between the residential and commercial in broad terms. Then I will look into the market insights of both sectors. Then we'll analyze the profitability comparison, which is the main subject. Then I'll run through opportunities in commercial property. Then I'll run through some case studies, a conclusion, and then the final thing will be the questions and answers. Okay. Right. So I presume most of you coming to this webinar is that you would understand residential developments purely because it's something that you are within every day. It's a very emotional side of things, and you've all been renting or alternatively bought a home. So you completely understand if you had to develop residential. However, when we start looking at commercial developments, it can be a lot more lucrative, but it is important that you have the knowledge and expertise. So it's like anything that is unique in itself. There's a higher return, but you have to gain the knowledge and the expertise into developing anything that is commercial. You almost have to have a business mind when you tackle it. Okay, let me just go through the types of residential developments. And this is a broad spectrum. It's so to define residential developments, it's simple as housing accommodation for individuals and families that can purchase and live there permanently or semi-permanently unless you're turning over a number of homes. But the fact is that you're actually living in there. So it's more an emotional side and it appeals more to the mums and dads. So look at the various types of developments that you can do in residential. There are renovations, speculative homes, that's one-off homes, small unit developments, which are duplexes, triplexes, quadruplexes, group housing, which is slightly an extension of that. Then you break it down to villas, like for example, retirement over 55s. That's what define as villas. They're generally single story. You have townhouses, generally two-story, and terrace housing, which is predominantly in Sydney and Melbourne, and there are snippets of it happening here in Perth. Apartments or flats, right? In America, they call it multifamily. Seniors housing, a retirement and lifestyle villages. Government housing, which is social and community housing. Residential land. Then we go into niche developments, which are basically holiday homes and cooperative housing. Now, let's start looking at the commercial developments, and let's define it first. So commercial developments involve constructing buildings that businesses or individuals can lease on a long or short-term basis to generate rental income. So you can see that it is quite different to the residential type of developments where you're actually selling parts of it to third parties for accommodation. Now, let's break it up into various sectors. There are some broad sectors, which are generally office, retail, and industrial. There are three main sectors, but let me run through offices. Now, offices is not purely just one big office tower. You can have a renovated house. So, excuse me. Renovated house. You see many of these where doctors actually renovate an old home on a corner and they turn it into a little medical center. Then you have strata title offices. Those can be units that can be sold off to individual small businesses. Then you go to further type of developments, which are called office parks, which is predominantly small little office blocks within the park setting. Then your multi-story office blocks, which are generally in the city. Now, retail sectors is quite interesting because you think just retail or a shopping center. However, retail goes further. You get your corner shop convenience store. You get your strip shopping, which is generally in street level and in some of the older suburbs. You also have it now in some of these bigger centers where it's all strip type shopping, individually owned or sell to individual investors. You have, when it comes to shopping centers, there are the various sizes. A neighborhood shopping centers, anything between 1,000 square meters to 5,000 square meters. And you have a district center, which is 5,000, 20,000 square meters, and a regional shopping center from 20,000 plus. Then you have hypercenters. These are real bulky stores, which is about 20,000 square meters plus. Then you got your theme centers, and these vary in size. It's all surrounded by a theme. Some of them have theme parks surrounding it. And then you have your discount and factory outlets. I'm sure you come across them. There's one here in Perth near the airport as well. Then we go to industrial buildings. You get office warehouses, you get distribution centers, you get warehouses itself, manufacturing facilities, factory units, which are strata titled and sold off individually, mini storage, and one of the growing sectors are data centers. Then you have hotels and leisure type of developments, which are your hotels and resorts. There are motels, service apartments, entertainment centers, waterfront developments, theme parks, and golf courses. Then we go into the medical side. You got your suburban medical centers, your neighborhood medical centers. That is more like super clinics. You get private hospitals, and then you get your nursing homes and aged care. Then you go into the niche markets. You've all heard of childcare centers, student accommodation, co-living, science and technology parks, conference centers, petrol outlets, which will be your EV stations in future, parking lots and garages, theme parks, and casinos. And those are generally just one-off projects of those last few. Right. So let's compare the two between residential and commercial. This is just in broad terms. The profit section I speak about later in this webinar. So in general, the valuation for residential is based on supply and demand in a specific area. Your research, when you're looking at developing in a specific area, your market research is within that zone. So it's more localized. It's not the whole time. For example, developing in the suburb of Perth, you're not going to analyze the whole of Perth because of pricing. The DA process is a lot shorter. Construction is a lot more simple because there's a methodology that is adopted in each different state. However, there's a lot more competition amongst developers because everybody wants to get in because they understand it. You have a larger purchaser base because everybody's looking for a home. You got ease of finance because banks understand residential and they like to acquire mortgages, etc., from the actual purchasers. The buyers are less complicated, although it's mainly emotional. However, the yields, the returns are lower. When you rent it out, the vacancy period is a lot shorter because everybody's looking for a home. So let's look at now the commercial side, when we look at valuations. Now, I will go in depth in terms of how commercial properties are valued, but it's based on the net return of the property. It's based on the income. The market research will always be broader because it's a larger demographic that you would come to a business. The DA process is longer. However, there are areas where if it's zoned, you have less complications. The construction can be complex, but that depends on the design. There's less competition amongst developers because there are very few of those developers that focus on commercial. Your purchaser base is a lot smaller. However, the purchase base have a lot of money. The funding of these projects are a bit more complex because there are varying ways of doing. For example, there's standard formats that if you're developing residential, you've got to put 30% equity in and you can borrow 70% from the bank or lender. There's various ways to fund commercial projects. The buyers in commercial projects are a lot more sophisticated because predominantly they are business people. They're looking from an investment point of view. The yields are higher, but because of the numbers, but besides that, the percentage is a lot higher and the returns are a lot higher. The vacancy periods, once it's on hold, it tends to be a lot longer, because if somebody moves out of a shop, it takes a bit longer to rent it compared to a house. So let's look at some of the market insights that is happening currently in Australia. There is a strong demand, mainly because of the shortage of housing supply throughout the country at the moment. However, interest rates have cooled the market for first-home buyers. There's not many first-home buyers coming onto the market. Affordability issues. Out of all the cities, affordability is the major problem. Even though the government incentives, the schemes are taking, or put it this way, it's taking a lot longer for people to enter the market because of the high property prices, especially in Sydney and Melbourne. One of the biggest problems at the moment is the builder shortage. There have been so many bankruptcies throughout Australia. Even here in Perth, we've just had recently a number of them collapsing. So that is causing a major supply problem. With the focus on climate change and talk about climate change, government is implementing a lot more sustainability areas or policies on energy efficient design and focusing a lot on renewable energy. So let's look at commercial developments. Okay. So what's been happening in the commercial space is a bit varied. Industrial buildings are still in demand because of the growth of e-commerce. COVID has created that because everybody's doing shopping online. The office problems, or the office has a bit of a problem because what has happened because of COVID, most people work from home and the vacancy rate has not reached to a sustainable level. Retail, interesting, is all changing and it's focusing more on mixed type use of developments. So where are the growth areas? The growth areas are specifically in the healthcare sector, which means medical centers, aged care, data centers, and because it's a specific need and they are pretty resilient and long-term, they do have long-term growth. Another area that is coming to play, which I'll explain a bit further, is the ESG focus. Investors are looking for ESG assets because they are a bit more stable in terms of...
Passengers, your next service departs in 9 minutes. This service stops all stations.
Is somebody there? Okay. The rising interest rates and inflation is causing a problem because of it's not as buoyant purely because of the rise of these rates and inflation. So let's look at the overall market trend. Where is things heading in this particular climate and into the future? I mentioned about mixed-use developments, and that is a mix between residential and commercial, because what it does, it combines living, working, and recreational areas all under one specific area. So what are the benefits of mixed use? It maximizes the land use and it enhances urban density. It's efficient use of land. The economic benefits. You can imagine that if you have one type of development, you get one type of demographic. For example, you build apartments, you're only going to look at rental income from owner occupiers. But when you have a mixed use development, you've got a diverse range of revenue streams because you've got retail and you've got probably medical and you've got apartments or normal residential type rental. What it does, it creates a community within that type of building or within that development. And the lead on most of these, you start improving the sustainability and reduce environmental impact because most of these developments are occurring within transport zones, which we can see there's a growth in these areas within what we call transport-orientated developments, which are called TOD sites. It is attractive to investors and the tenants because of multi-use. And I mentioned about the amount of investors are looking for ESG assets. And the government is pushing towards this type of development. And if you have that type of development, the government process is a lot quicker because there's a policy they're trying to push at the moment. So let's get to the key subject, the profit comparison. So when we start looking at residential, now, as I mentioned, valuation of a home, when you want to sell it, it is generally based on market comparison. What is a similar house that of same size within the suburb, what does it sell for? That will actually create the price. The average profit margin that developers have been making or looking in residential developments range from 15 to 25% of the total development cost. The exit strategy for developers to get out and make their money, obviously, there are multiple purchases, but there could be delays in your settlement and final profit. So let me give you an example. If you do apartment development and you've got 50 units, there's a theory that goes around saying that about 10% of the apartments remain unsold for a period, and that's where your profit margin is sitting. So you could be sitting there for a while. I know one development within my suburb that 20% of the apartments were not sold. So it meant they had to rent it out. But guess what? The return to investors did not come until everything was sold. Now, let's look at commercial. The valuation is based on a capitalization rate method, which means calculating the property's net operating income less operating costs. That will give you valuation. Now, the next slide, I'll explain how that capitalization rate works. The average profit margin that developers seek from a risk level in commercial is 25 to 35% of the total development cost. Now, when you compare that to residential, which you can see is a lot lower. Now, what are the exit strategies for the commercial side? Generally, you'll find it's a single purchaser, which could be an institutional fund. And generally, these funds are looking anything between 5 to 7% return, which I will explain when we go to the capitalization rate. So the capitalization rate, some people call it a yield, is the rate of return on the value of the completed property that a potential investor would expect when purchasing the property. Each commercial property type will have a different capitalization rate based on the associated risk and level of management. So let me explain that. If you're within the Perth or one of the major cities and it's a good location, you'll find that the institutional investor would pay anything between 5 to 7%, depending on the conditions or the economic conditions at that particular time. When the economy is buoyant, they would probably accept a lower return. But for example, if you're building in a regional area or developing in a regional area or regional town, the capitalization rate or return they expect would be a lot higher because they consider it as a higher risk. So how does the formula work? So if you look at very carefully, it is the net operating income, right, divided by the expected yield that you would get, and that will give you the value of your property. So let's say, for example, the figures below, the net operating income is 1.25 million, which means that that return is after all cost. So bear in mind, it's the net operating income, it's not the gross. And then you divide it by the factor of 7%, which is 0.07. That value of that building, when you sell it to an investor, is 17,857,143. So they're quite happy to make that money or pay for that building, even though you developed it and it might cost you 12, 13 million. All right. So there's a massive upside as far as that is concerned. They're not particularly worried, but most of these funds are not prepared to undertake the development risk. So they're quite happy for developers to make that money. I think similarly, you find that in the mining sector. You get your junior miners that do the oil exploration. They build it up and then they sell it to the likes of BHP. So it's nothing dissimilar to that sort of type of concept. So what are the opportunities in commercial? Now, I mentioned about the growing focus of institutional funds looking for investment in ESG. Right now, there's so much information on that. If you Google it and just type in ESG, you'll find that people are talking about it. So for those who don't know what ESG stands for, I'll explain it, because several times I just carry on babbling on and people say, oh, what is ESG? So ESG is environmental, social, and governance. These are standards going to be implemented by the government very soon. They have been implemented in the likes of Singapore, the UK and America, and parts of Europe, whereby big funds or big companies have to do ESG reporting, meaning that they got to do a report on what they're doing about the environment, what they're doing on the social side, and how they're governing their organization. So what is happening is that a lot of these pension funds, they allocate anything between 5 to 10% or more, 50 to 20% of the total portfolio towards ESG assets. Now, there's a high demand and limited supply of these assets because this have been implemented only in the last, I would say, 4 to 5 years. So institutional investors are looking for ESG assets, right? But none of the buildings that are about, if somebody's selling it, are ESG compliant because they were built or developed prior to the implementation of ESG. So if you're going ahead and you want to make some good money into the commercial sector, if you're one of the early adopters, you obviously will set a precedent, which means that you set up the standard as a developer that focuses on it, which will give you future opportunities as well. And as I mentioned, it's aligned with government policies. So the government is pushing towards that. They're even to the point now, the governments have available grants. You'll see that, for example, the energy sector, there are a number of grants if you apply renewable energy to your project. In terms of risk and risk mitigation, it's pretty resilient. You'll see future investment will be focusing in this particular space. Okay, so I'll just run through some case studies. Just some past projects I've done on a personal basis. These are without any investors. In terms of commercial, this is a project in Walters Drive here in Perth, in a office park area. It consists of 8. You see all the 8s because being Asian, I suppose you say I'm working on the 8s. So what it was is that it actually was a syndicate of builders and architects and engineers. So each one our own office. We put the whole thing together, but each one got our own unit for wholesale, and we sold the balance for profit and shared the profits. The one below is a neighborhood shopping center that was in South Africa that I did totally on my own. I was 39 years old at that time. Took a high risk, but developed it and completed and sold it to an insurance company. So I'll go to another case studies where current projects we're doing. There's 2 of them. The one that Sue is an investor in, that's the manager of Smart Community. It's a mixed use project and it aligns with the principles of ESG. So we're going to be a forerunner into this type of development, as I mentioned. And we are speaking to potential ESG institutional funds. I've got meetings with them next Wednesday to see how we can progress a collaboration further. The one below is still very early stages, but it's in Karratha. It's also a mixed-use development, and similarly, it will be based on ESG principles. So that concludes my presentation. As you can see, my background there, these are all the courses and the books I've written. I did mention those who attended this meeting. If you'd like to do any of these courses, just send me a message and I'll grant you a coupon and offer you a 50% discount for attending. Whether you're a residential developer or a commercial developer, everything is there. But it does go into higher levels where the last part of the full course actually helps you to run a business as a developer, what we call a development manager.